Hey guys, Ken Calcutt here with Cornerstone Financial Management. Wanted to spend some time and go over this big, beautiful bill that I'm sure you guys have heard about. We get a lot of questions about what's in it, what's not in it, and there's a ton of information. So I want to dive into some highlights that are relevant to a lot of people. It may not apply to you, that's fine, but a lot of these changes or extensions will apply to a lot of you, and so it's helpful if you understand what they are, how they work. I'll preface this with this is not intended to be any tax advice or financial advice for anyone. This is general information that hopefully helps you understand these new changes to the tax laws and the financial laws. So I'll dive in. I'll start with some of the things that were kind of extended. These were features that were already in our tax code that were either made permanent or maybe improved. So a few things that I thought were worth mentioning. The actual tax rates are effectively staying the same. They were going to go back to the old rates from prior to 2017, which would have been about 3% higher for each tax bracket. That's no longer going to happen. The current tax rates were made permanent. So the top tax rate at 37%, that's kind of staying where it is. So the tax rates per bracket are not going up as they were supposed to go up at the end of this year. The standard deduction was made permanent. Current rates are $15,750 per individual, $31,500 if you're married filing jointly. So that standard deduction will stay in place, and I do believe it will go up with inflation going forward. The SALT increase, so this is state and local taxes. So and that was a real point of contention in this discussion around the bill. The state and local taxes that we pay, there was a cap at $10,000 that was deductible on your federal taxes. So even if you paid more than that in state taxes, local taxes, property taxes, whatever, you could only deduct $10,000 of it. Well, they increased that to $40,000. So a huge increase here. Now, we're in South Carolina, the taxes aren't that bad here, but in a lot of states, the tax rates for this SALT tax, it can be a considerable amount of money. And so this was a big deal for states like California, New York, where the taxes can be significant. They wanted to be able to deduct more of those taxes on their federal. And so that changed. $40,000 cap now for state and local tax deductions. And the estate exemption, this is a big deal for financial planning. It was increased to $15 million per individual, which is substantial. So the federal estate tax will not apply to anyone's net worth that's less than $15 million when they die. So you can have a pretty substantial estate and not have concerns with federal estate taxes. So this is nice that this is in place. Let me jump to the next page and we'll talk about some new features in the bill. Okay, some new features that were added, and there was a lot of talk before the bill was rolled out about no taxes on Social Security, no taxes on tips. Some of it turned out to be that way, some of it not so much. So what we did see, there's an additional $6,000 deduction, just kind of a standard deduction, $6,000 standard deduction for anyone 65 or older, okay? It's important to note, Social Security income is still taxable. They're still going to treat it as taxable income, but if you're 65 or older, you get a $6,000 deduction per person in addition to your standard deduction or your itemized deductions. So I think that is intended to offset the taxes you're still paying on Social Security. So it's not accurate to say Social Security is not taxable. It is, but you're getting an additional tax deduction if you're 65. Now, I think it's worth noting, if you're 62 and you are collecting Social Security, you are paying taxes on Social Security and you are not getting this deduction because you're not 65. You have to be 65. Collecting Social Security before then does not allow you to take the deduction. You have to be 65 whether you're drawing Social Security or not. Next thing we want to see, you can deduct up to $25,000 of tip income and $12,500 of overtime pay. So you can basically treat that as non-taxable income. You can deduct if you have substantial tip income of $25,000 or $12,500 in overtime pay. Car loan interest is now deductible. I think this is a dangerous one, but it is what it is. Up to $10,000 a year of car loan interest is now deductible. Not sure why that's in there, but it is. It's deductible, $10,000. And there's now a $1,000 for individuals, $2,000 if you're married filing jointly, a charitable deduction for non-itemizers. So what this means is typically you only get to deduct your charitable giving if you itemize. Well, in the last few years, 90+% of the population does not itemize because the standard deduction is so high. So you just take the standard deduction. So in that case, you're not really getting the benefit, the tax benefit of charitable giving. So now they're saying, okay, you can deduct a little bit of charitable giving even if you take the standard deduction. So you get a little bit of deduction for your charitable giving, which is nice. A couple things on the next page I want to look at too. Okay, 529 plans. A couple of big changes here. You can now use 529 plans to pay for homeschooling expenses. That's a new feature, very nice. Anyone who's homeschooling, knows it's not cheap to homeschool. There's a lot of materials and classes that have to be paid for. Now you can use 529 funds to pay for those expenses. That's a nice feature. K through 12, if you're paying for private school for K through 12, previously or currently 2025, the annual limit to the amount of money you can draw from your 529 to pay for K through 12 private school is $10,000. In 2026, that's going to $20,000 per child. So a pretty substantial increase in the amount of money you can pull from a 529 to pay for K through 12 private school. This is a big tax deduction if you're in a state like South Carolina where contributions to the South Carolina 529 are deductible on your South Carolina tax return if you're a South Carolina resident. So in some states this is a big deal, in other states it won't matter because there's no tax benefits to it. So it matters what state you're in there. Okay, so the last thing I want to touch on are what we call the Trump accounts. There was a lot of talk about these Trump accounts. We don't have all the details of exactly how these are going to work or where they're going to be set up, but we have the framework. And what it looks like is the government's going to fund $1,000 of what we call seed money into an account for any child born between 2025 and 2028. Now, I have seen two different dates on that. I'm not 100% sure it's 2025 or 2028, but that seems to be the consensus from the sources I'm seeing. Any child born between 2025 and 2028, the government will give $1,000 into an investment account for seed money for that child's future. The family will be allowed to add up to $5,000 per year if they would like to. It's after-tax money that the family contributes. The growth in that account, it looks like the types of investments that are going to be required are going to be index type investments like S&P 500 index funds, things like that is probably what they're going to require. Again, don't have the details, but that's likely what it's going to look like. There is an employee benefit, employer benefit. Employers can offer a benefit to their employees where they contribute up to $2,500 to a child's account. If one of their employees has a child and the employer wants to make a contribution, that's allowed up to $2,500. The growth in those accounts is tax-free, so it sounds like it's going to look a lot like a Roth IRA. Growth being tax-free. No withdrawals are allowed before age 18 for that child. No matter what the circumstances, it doesn't seem like they're going to allow any withdrawals. But once they're 18, I'm guessing they'll be able to use the money for whatever, but it's going to be tax-free money at that point. I don't know exactly why the government's doing this, but it is something to just help the kids have something when they're grown, $1,000 per child born between 25 and 28. More details will come out on how those are actually going to work. Where are they set up? Do you have to set them up at a financial firm, at a bank? Is the government going to do it for you? I don't know. We'll find that out later, but this is the framework of how it'll work. So hopefully this is helpful. Some fairly significant changes on this bill and some things that stayed in place that we really wanted to stay in place. We'll put out more content about some of these changes and how it actually applies. There's some things here that are a little bit deeper impacting for folks who are doing some financial strategies like Roth conversions, but we'll do that on a different video. But I hope this is helpful. If you have any questions, reach out to us anytime. Thank you.